Hey everybody, how are you doing? Excited for you to be with me today. We are going to be going over some interesting topics that normally we don't talk a lot about. We've all heard about what's going on in Russia and Ukraine right now. And it seems like every few years or decade there's some type of conflict. It seems like there's always a conflict brewing, I guess. The markets go haywire, prices of gas go up. But how does this really affect real estate and real estate investors specifically? That's what we want to talk about. How are the best ways to invest during uneasy times that are happening, potentially what we're dealing with right now? I wanted that to be the topic for today. Let's jump over to our slides. How is real estate investing affected by an international conflict? A couple of things we're going to cover today. We're going to take a look at what's happened historically. We're going to see how things have already been affected. We're going to jump into what we are going to see during the ongoing conflict, what this means for real estate investing. So let's go back in time. Let's go look at some history. They say history repeats itself. Does anybody remember the Gulf War? If you do, type it in the comments. I would love to know. During the Gulf War, August 1990 was the start of Gulf War to February 1991. Pretty short. I was 12 years old when it happened, so maybe I'm dating myself. But that war happened, the Gulf War, right? So that's something we can look back and see. Then in 2020, there was a threat of an Iraqi war, okay? And in 2003, the Iraqi war officially started in 2003, and it lasted until December of 2011. A lot of people forget this. This war went on for 8 years. The Iraqi war started in 2003 and ended in 11. So there's been a war going on for quite some time. There hasn't been a significant war since 2011 that I think has been on the international scene. So I want to look back and say what's happened during these periods of time. So war with Iraq may threaten housing markets. So this was in 2006, which we are 3 years into the war while this is happening. They say the housing bubble is a lot like a devil. Even people who don't believe in it fear its power. I thought that was a funny quote. In 2003, while the Iraqi war happened to the real estate, regardless of whether there is war, Edler said, director of the UCLA Anderson Forecast, said people who already own homes should not be overly concerned about their property values. This was back in 2003 when people were like, oh no, what's going to happen? This Iraqi war is happening. What should I be worried about? And it's like, you probably shouldn't be too concerned. That's an interesting perspective from the Iraqi war. In 2003, while we were in Iraq, what happened to real estate? Well, I don't think the economy or the real estate sector in particular will be affected by a war one way or another. For people who already own homes, I think it's a good place for their money. Okay, that's kind of interesting. We'll talk more about this. The true economic effect of war will be determined by the conflict's cost, duration, wear effect on investors, and consumer confidence, says the chief economist of the National Association of Realtors. So, and I think this is still true today, right? It's going to depend on the cost, the duration, the wear effect on investors, as well as consumer confidence, and that's to be seen. That's something we can't predict, so it's a little bit of a crystal ball here, but I like the direction of thinking like that. Historical economists say major wars have fueled more booms than recessions, okay? More booms, meaning the market going up, more than markets going down when we're dealing with major wars. In the war, in World War II, for instance, defensive spending reported helped catapult the sluggish U.S. economy, helped us get out of a bad economy, was one of the things that happened for World War II. The recession that followed the Persian Gulf War lasted 9 months, ending in March 1991. However, the current economic slowdown had began in March 2001. And most experts predict that the short war would have a negligible effect on the recent economic recovery. So, it's fair to say that war unto itself rarely has a direct impact on commercial real estate, and I would say residential real estate as well. Instead, wartime activities can cause instability in the marketplace. And that's the real question here, is what type of instability, what type of wear does that have on investors, and what does that do for perception to follow patterns in in what we're seeing here. So the war in Iraq is partially to blame for the extreme shortage of U.S. homes for sale, according to Redfin, reported by Fortune. I think this is really interesting. After months of rampant competition and high prices, the invasion of Ukraine has added even more fuel to the fire created by extreme shortages of homes for sale, driving prices even higher. That's interesting. Those are the words of Redfin, the real estate brokerage firm whose weekly updates have a real-time catalog of America's pre-pandemic housing crisis, with prices shooting higher each and every week. So here's the other thing we're looking at here, guys, is the Fed's interest rates. They have raised interest rates for the first time since 2018. So what does that mean for us? The Federal Reserve officials voted Wednesday to lift interest rates and penciled in 6 more increases. So the Federal Reserve is planning on increasing it 6 times. And the Federal Reserve, that's what banks borrow at. So what this is is what banks are borrowing at, and they're saying we raised it and we're planning on raising it over the next 6 times. The most aggressive pace in more than 15 years in an escalating effort to slow inflation that is running at its highest levels for 4 decades. So officials signaled they expected to lift the rate to 2% by the end of this year, slightly higher than it was the level prevailing before the pandemic hit almost 2 years ago. That's when they slashed rates to 0. So basically banks were borrowing at nothing. And now we think it's going to get back up to 2% by the end of this year. But that's exactly where it was before COVID started. So what is that really going to do for us? Well, the Feds are hoping it's going to slow down the inflation. Their median projection shows the rate rising to 2.75 by the end of 2023, which would be the highest since 2008. What is Fed interest rate? This is the rate they borrow at. And government borrows, or borrowing from the government, that's the rate that it's at. So what affects this? Well, it makes higher rates for consumers. Now, it's not a one-to-one. If the Fed raises it, a quarter, doesn't mean your rates will raise a quarter. It could mean they raise more than that, or they could raise a little less than that, because the bank's trying to make a margin, which is the difference between what they borrow from the Federal Reserve and what they give it to you and I at, and the difference is their margin. And that's what they want to make. They want to be making a margin. Now, officials are facing the prospect of an even higher inflation due to escalating sanctions by the West against Moscow, which risk higher energy and commodity prices, together with the new pandemic lockdowns in China that further roil battered global supply chains. So what we're seeing here is the effects of not having the supply chains like we needed because of the effects of COVID, but now we're seeing the sanctions, which is making it even worse to get some things in the global supply chain. So why are they raising the interest rates? Why is the Fed raising the interest rates? Well, they're really concerned about inflation. Well, what is inflation? Inflation is the prices of goods and services or housing go too high, too fast. That's the official definition of inflation. The idea is a gallon of milk today costs you a lot more than the gallon of milk cost you last year for the exact same gallon of milk, okay? So that's inflation. What did it go up for the same goods and services? So I think there's a reason to be concerned about this. I think there is. I think it's something we need to keep an eye on. So, and I want to go back to the statement again. The true economic effect of war will be determined by the conflict's cost, duration, and the wear effect on investors and consumer confidence. I just think that really sums it up. Anybody that says, it's going to skyrocket, it's going to go down, everybody's guessing. Then I'm saying, well, how in the world does this affect me? Like, what does all this have to do with me as a little old real estate investor or somebody that's wanting to become a real estate investor? Well, there's a few effects. Number 1 is oil. Okay. Number 2 is supply chain. Number 3 is interest rates. So let's talk about oil. Oil jumped to $139 a barrel at one point, the highest level we've seen in 14 years, while wholesale gas prices for the next day delivered more than doubled. That's really interesting. In December, crude oil was around $75, and you can see it jumped to $139, almost doubled what we're seeing there, which is an effect because of the uncertainty and the sanctions on Russia. Oil prices directly affect the prices of many goods and services, or many goods. Petroleum, okay, oil and petroleum. So rising oil prices could affect thousands of products, guys. There are thousands of products that use petroleum oil derivatives. So it's not just about having to pay more at the pump. We're also seeing any product that has an oil derivative, like petroleum, is also going to be going up in price, or potentially has a good potential of going up in price. So shoes, handbags, vegan leather, for instance, are all petroleum-based products. It's really funny. Somebody's got vegan leather because they don't want to use real leather, doesn't realize that they're using petroleum to make that. It's kind of interesting. So our nylon stockings, microfiber fleece, all sorts of other clothing material. If you wear sunglasses, the cost of polycarbonate lenses just went up. Adding, he believes prices will go up almost all goods in connection with oil or oil products, okay? So we're going to see goods going up. I think that's going to happen. So everything made out of or packaged in plastic will be more expensive. A lot of plastics are made with polypropylene and polyethylene, and the basic building blocks of those are propane and ethane. So that comes from oil. Rising oil prices will also show up at grocery stores, right? Because now it costs more. It costs more for the farmer to end up plowing the field. It costs more for the whatever they are. Let's just call it potatoes to go from there to your store. And then, so you've got the trucking and those types of things, which are going to be more expensive. Industrial fertilizer has fossil fuels, and so that's going to become more expensive. It'll have an effect on the price of grains. Plus, it gets passed on to the customers, right? So if somebody has to spend more money for fertilizer, which does have a fossil fuel component to that, and then they have the grains, which are going to cost them more, and then those grains go to chickens, and those chickens eat it, and it costs them more to buy it, you're going to see this trickle effect of seeing prices go up, because it all starts with that one sector of oil. So what are we going to see? We're going to see higher gas prices. We're already seeing it. I think that's going to continue. We're going to start seeing higher product prices. I just think that's a given. We're going to see that. We're going to see higher service costs due to higher product prices. If it's going to cost more for the contractor to get there and all his guys to get there, at some point that contractor is going to say, we got to raise prices a little to cover our cost on this. Now, are they doing that now? Maybe, maybe not. Those are things that I am seeing, I think we will be seeing. And the Fed did just raise the Federal Reserve, and they have plans to do it again. So we're going to see interest rates going up as well. The Fed will keep a close eye on the higher product and services as they consider the next rate. So basically they raise it and say, hey, let's see what happens. We'll be back next quarter. At this point, they're planning on raising it 6 other times. I really think this is a sign that the Fed believes the market is going to remain hot if they don't raise rates. So here's where I'm at. If the Federal Reserve thought that the market was going to crash like you're seeing on YouTube and people saying all the time, why would they raise interest rates? Because they don't want the market to crash. They're raising interest rates because they think that the market is too hot and needs to be slowed down. They're not trying to crash the market. If they were worried about a market crash, they'd take rates back down to 0, okay? And they've steadily been bringing rates up anyway. It's a big increase. Let's talk a little bit about supply chain. There are going to be delays and hard to find items. Like right now, I'm trying to replace a stovetop. We've been trying to get it. We still don't have it. It's because there's delays on where it's coming from. It could be gas prices. It could be fuel. With that, we're also seeing this increase in supply and demand, right? So there's just more appliances is a good thing. This is a stovetop. It just got postponed again. Materials for housing can take months to get in. This is something to be aware of, especially in fix and flips. You're going to need a plan for a longer rehab, and you're going to need to buy what's in stock. Do not go and say, find what you want and then go order it. You have to find what's in stock and then decide what looks best, what's in stock, so you can do it now. The reverse can get you in a lot of trouble, and you can be hating life if you get in that situation, spending more money and waiting for something. So the next thing I really want to explore here is, what do we think is going to happen to real estate values over the next little while? So time will tell. I don't have a magic crystal ball, but At some point, it seems like there are more buyers than sellers right now, right? There's just more people that want to buy than want to sell. That's what we're seeing right now. So, and we're also seeing the job market is really strong right now. So those two things combined leads me to think that we're going to continue to see higher prices, or at least stable prices for the next foreseen future. I think that's what we're going to be seeing here. Is there going to be some slowdown? I think we will see some slowdown, but it's not going to have this major crash that's going to be happening overnight. I just don't believe that. I don't think we're going to be seeing that as a result of the conflict.